Alright guys, welcome back to the Crypto Boys. Joe P here with you, talking about another awesome video. What we have on store today is, of course, the looming inflation, the looming Fed interest rate hikes, and how it is going to affect the crypto markets. Stick around, we have lots to talk about today. So some of these charts today that I'm going to talk about are like a couple months outdated. So I'm going to basically compare and contrast and show you exactly how they are overlaid on top of each other. Inflation right now, it is record high. It's definitely the highest it's been since 1984, the highest in 40 years. The current inflation rate, about 7.7 as of October. The Fed's goal is to get this inflation down to 2%. That's right, 2%, which is back around here. We are well above that right now at about 7.5%, meaning we have a long ways to go. And it's not an easy road, I'll tell you that. It's a bumpy, it's a bloody, it's a terrible road. So how the heck do we get there is the question. Well, first off, the Federal Open Markets Committee, or the FOMC, sets the federal fund rate. Basically, this federal fund rate is just a range that the U.S. banks loan each other money when they need money going out. So that will affect how much you are going to get and the percent that it costs you to get your money. So it's a little bit more costly, or at least that's kind of their goal, is so that you can't take out cheap money. The interest rates had to go higher and higher and higher to curb inflation. It's one of the only ways that the feds have to be able to drop this inflation that much. Unfortunately, it's potentially going to drive us down into a recession because you're not going to be able to get cheap money. Things are going to a little bit more expensive as of right now. People are going to start losing their jobs. Other things are going to start happening where layoffs are going to start happening, and the markets overall potentially are going to be impacted negatively. Here's a chart of the federal funds rate. Over the last year, I mean, clearly it was pretty much zero. You can borrow money for pretty much nothing. Pennies on the dollar, of course, which was awesome. You can take out a massive loan and you don't even have to really pay it back. You're paying back like super small percentage. We refinanced our house because of it, and it's super cheap to do so, which was awesome. However, right now it's at 4%. Now 4% over the long term, the last 10 years, of course, is definitely the highest it's been in a long time. But if we're looking back 25 years, this is the highest that it's been since, really, it looks about 2006, 2007, right before that crash when it came back down in 2008. The Fed funds rate, of course, is extremely high right now, and they are tightening down tighter and tighter and tighter. Jerome Powell has come out to say that it's probably going to continue this way into 2023, but it will slow eventually. And it will slow eventually once we start to see inflation start to go back down, because they don't want to go over what they thought and just jump it right up to 6 or 7 and destroy everybody's soul, not be able to get a single penny out of the banks. They're not going to be able to lend money. They're not going to be able to make money, meaning that the stock markets are going to go down, and that is just a disaster. That is deep depression. Like, we're in big, big trouble if that happens. So they do not want to overshoot. They want to hit it right on the dot. However, it's a lagging indicator of what they're actually doing. So it's a really tough job. I'm glad I'm not in that position, I'll be honest with you. Now, we just talked about how this is the highest inflation has been since 1984, really, over 40 years ago. But when it was there, if we're looking, we're right back up at that peak right now. Now, this is slightly behind as of the last couple months. So we went up a little bit more, and then we are starting to come back down. But I like how this is overlaid with the federal funds rate right here. As the federal funds rate is starting to go up, hopefully this inflation starts to go down. The issue is that over the last couple times, when it does go up, when it starts to flip in the early 2000s, we have a massive decrease in inflation. When it starts to flip here, massive decrease in inflation, which is what we want. But again, it's kind of lagging. So if we kept going up, up, and up, this would hit a sharp, steep decline down. And we do not want that, even though it's so high right now. They have to be very, very careful. What about the stock markets compared to the U.S. interest rates? Well, here we go. The Fed fund, of course, again, like I said, this is much higher than it is right now. We're actually at 4%. So this is behind. So we're really up here on this chart. This is this is way higher than it's been. So the stock markets, though, the stock markets are actually going up a little bit. I'm going to pull those up here in a second of exactly which ones have done what. It's not going to be long term. I mean, if you look right here, so much money was printed in 2020. 70+% of the circulating dollar amount in the United States was printed in 2020. Clearly, that's why we made this trend here. There is absolutely no way that can continue on forever, and if you think so, I hate to say it, man, but you're in big, big trouble. But one way to stay out of trouble, I will tell you, is make sure that you smash the like button for us here at the Crypto Boys and subscribe to the channel if you have not thus far. So currently, I like this chart as well. It's looking at the funds rate, of course, which again is really more kind of right above here. It's at 4%, not as high as this. It's slightly below it, of course, but we're looking right around there. And again, the S&P was still going up this entire time. You can get cheap money right down here, and everyone was getting stimulus checks. That's 70+% of the US dollars being printed. Of course, it is going to go up. Now, the flip is going to happen at some point, though. You guys are going to have to pay attention to this flip that happened right here. Boom, tanked. This flip that happened right here, boom, tanked. And these are the most relevant data that we've had over the last 20 years or so. There's other, data back in the past, but most recently, these are the things we want to pay attention to. So the Crypto Boys are paying attention to it, and I really put a lot of emphasis in the S&P, Dow Jones, NASDAQ, all that other good stuff on the traditional markets. How it will affect the crypto markets, I think they are very closely related, and it is going to impact it. They will move together. I hate to say it, but they're going to. So currently, S&P over the last 6 months is about the same, honestly. I mean, it's down 1%. It's pretty much exactly the same. So it's had its ups, it's had its downs. It's kind of hanging out exactly in that same spot. Dow Jones not doing too bad, up about 5% over the last 6 months. So it had the exact same trend, up, up, but it just went a little bit higher. No big deal. And unfortunately for the NASDAQ, it's down about 5%, so everything's really equal. S&P is sitting about the same, Dow Jones up about 5%, NASDAQ about down 5%, so realistically, we're hanging out about the same. I mean, there's not much crazy stuff going on in the market right now that's telling you up or down, but you have to be paying attention to the fund rate and the consumer price index and how it's going to affect us. So you guys have to understand that all we do here on the Crypto Boys is give you our opinion on what's going on in the world. Crypto, of course, is our niche of what we love to talk about, what we love to research every single day. But if you are blocking out the traditional markets and not paying attention at all, you're missing a huge piece of the puzzle. And this is just statistical data of the past, of course. This is where it's been before. This is where it's heading in the future, potentially in our eyes. So is inflation and CPI still way too high? Absolutely. Is it getting better? I think so. We saw gas the other day in Iowa here for $2.99. That's the lowest I've seen it in a while, actually. So that's kind of promising. But there's a lot more blood in the street to be had. There's a lot more rocky roads to be driven on. And unfortunately, there's probably a lot more layoffs. There's probably a lot more people losing their jobs. If you can just maintain your job over these next year, because that's how long I think it's probably going to take for everything to really level out. If you can just hang on and just invest while you can and get into good projects in crypto, I truly believe that if you do so appropriately, when the traditional markets start to take off, crypto is going to follow, and we are going to be in a beautiful, beautiful place, setting new all-time highs everywhere you look. So that's just my snippet on tying things together with some charts. Now, of course, if you guys liked the video, like I said earlier, make sure that you smash the like button and subscribe to the channel because we are putting out awesome content all the time, mostly about crypto, a little bit about the stock market, a little bit about fitness, a little bit about everything, but mostly crypto, of course. And as always, thanks for rocking with the fittest crypto channel on YouTube. We're out.